Welcome to the channel! I will continue from where we left off in the last video. Previously we mentioned that 10% is a commission for Shopee to break even, or thereabout. This is possible as mature players are already charging 10 to 15% like eBay and Amazon. You can find a link to the previous video in the description. In this video I will share what to look out for if a company is making loss by accounting definition. As for all videos, please do your own due diligence. This is not an investment advice. For full disclosure, I have holdings in C Limited. The management has reiterated many times on the earnings call that Shopee is in the early stage of growth and therefore will continue to reinvest aggressively in the business. In the corporate life cycle, C will be between post-launch and at the start of the growth cycle. The stock may not be suitable for you if you are not comfortable with loss on its P&L or you hope to see dividends in the next few years. A long-term view is key to ride through the volatility of a growth stock like C. Reinvestment would mean pouring lots of money in sales and marketing to grow its ecosystem of buyer and seller. Looking to the left of the chart, sales and marketing had to be incurred upfront even when there was negligible revenue as Shopee just got started. As the business scales up and you look to the right, percentage of marketing spend declined rapidly and has stabilized at a level of about 50% in the recent quarters. I will continue to watch this percentage closely such that it does not overshoot as it enters new markets like Latin America, Poland, France, Spain and India. If you imagine the business to be at mature stage and you strip out sales and marketing, Shopee would have been profitable. You might argue that buyer and seller would leave Shopee without sales and marketing. This may not be the case if Shopee can establish a clear dominance and generate clear value to all in the ecosystem. This would mean having to drive the network and flywheel effect. Attracting more sellers lead to more product variety, buyers will have more choices, better shopping experience which lead to more sales. This will increase the scale of business for sellers and lower their costs and therefore attract more sellers to the platform. The cycle repeats itself. Driving this flywheel requires heavy reinvestment and foregoing revenue at the same time. For example, Shopee won't be able to charge commission for seller sales on the platform. They have to give free vouchers to buyers while hiring more staff to improve the platform. All this would mean incurring high expenses while having low to no revenue. So when can monetization really start? It can only happen once Shopee dominates and delivers sufficient value to justify higher commission to sellers. If you look at the table on the right, will you as a seller pick platform A or B? Is it A that charges only 3% commission or B that charges a higher commission of 6%? The answer is B as it drives 2.7 times higher sales volume and therefore you will earn a higher absolute profit which will more than justify the higher commission. If Shopee is dominant, seller is unlikely to leave even when commission increase. That's the point I'm trying to drive here. For your information, I used 2.7 times as an example as Shopee GMV was indeed higher than Lazada by 2.7x. Looking at the bottom right, Shopee has also invested into building equity with the community. For example, there was a partnership with the West Java provincial government in Indonesia to establish Shopee centers that will serve as local e-commerce hubs for more than 5,000 villages there. In Vietnam, Shopee launched Shopee Farm to enable Vietnamese farmers to go digital. This will involve helping them to run training sessions to teach farmers the necessary skills to sell and promote their agriculture's products on the Shopee platform. These are important contributions to the community while building the C ecosystem. While there are clear benefits to reinvest for growth, there must be a route to profitability. Previously, I explained unit economics in the video. Shopee make loss on every order, which means higher total loss when sales increase. So instead of looking at total profits, we should track loss per order, which has stabilized at around 40 cents level while commission is on the upward trend. Given that Shopee is reinvesting heavily into new markets, it is a relief to see a stable loss per order and likely to tell us that monetization efforts in mature markets have gone well to subsidize the loss in new markets. For example, management actually shared that Taiwan and Malaysia have been profitable before allocating for corporate costs. So what is the lever to drive commission or take rate higher like what you've seen on the chart? Besides seller commission, management mentioned that advertising is at its infancy stage of being monetized. I will draw a comparison to Amazon as it disclosed advertising revenue for the first time in the Q4 earnings recently. That's the fastest growing revenue line in Amazon business at 33% year on year in Q4 and also accounting for 9% of Amazon's e-commerce revenue. What I'm trying to say here is advertising may contribute meaningfully to Shopee growth in time to come. While C as a whole is having net income loss, its operating cash flow has turned positive since 2019. There is net inflow of cash for its operating business. This is because of two reasons. One, C is paying their staff via stocks or known as stock-based compensation (SBC). This is an expense item or negative item in P&L, but there is no actual cash outflow. Secondly is due to net working capital. Imagine C can collect upfront cash from gamers who buy in-game items, while supplier vendors do not demand for immediate payment for the service rendered. The timing difference will mean that the cash held by C can be used for other business purposes in the meantime. Lastly, it's important to acknowledge that C has an internal cash cow in Garena to fund growth. This reduces the need of having to raise cash from shareholder or debt, which means being able to be self-sufficient. If I am to compare to other companies, Lazada as a subsidiary of Alibaba will be at the mercy of its HQ for budget allocation. It remains to be seen how much ambition and therefore capital Baba wants to put into Southeast Asia. For Grab, they have driven their ride business to profitability by adjusted EBITDA basis that will have helped them to fund its loss in financial services and food deliveries. However, their profitable ride segment has actually declined in operating profits by 26% year on year in Q3 2021. This is not a good sign as there will be less profits available for reinvestment into the business. Similarly, C has the same worry as well in Q3 results. If you have read the numbers, you have seen that Garena growth in bookings and active users has remained pretty flat. This is definitely something that I watch closely for in the upcoming Q4 results. To conclude the video, reinvestment is critical to build an ecosystem of buyers and sellers for a young e-commerce platform like Shopee. This would mean having to incur high sales and marketing costs whereby low or no revenue is received at the start, as Shopee has to continuously give free vouchers to buyers and charge no commission or low commission to sellers. Monetization efforts can only start once the company establishes a clear dominant position and being able to deliver sufficient value to ecosystem partners. However, this doesn't mean that profits is not important. It just means that we have to be more patient and take a long-term view when we invest in such companies. At the same time, we also continuously and on disciplined basis track the route to profitability. So there are a few points that I think I have to highlight for Shopee, or rather simulated here. First is that the sales and marketing expenses has stabilized in recent quarters. If you have to strip out S&M expense, Shopee is actually profitable. And secondly, we can see that the take rate is on upward trend. This shows that the company is able to monetize without chasing away buyers and sellers from the platform. Also, we know that advertising would be an important monetization driver in future, and it's still at its infancy stage as mentioned by the management. And thirdly, it's heartening to know that loss per order is stable at 40 cents despite more aggressive efforts to push into new markets. We also know that emerging markets like Malaysia and Taiwan has turned profits. This shows that the business model is actually viable and will really generate cash flow and profits in time to come. And lastly, we know that C Limited is a cash flow positive company due to its internal cash cow it has in Garena. So to sum up, loss-making is not an indicator of company quality. More deep dive has to be done before we conclude. That's all. I hope you have enjoyed the content. Do comment on how I can do better. Really appreciate your time. Thank you.